What if I told you that a teacher in rural Kenya could own a fractional share of a Manhattan skyscraper? Or that a factory worker in Indonesia could invest in a Picasso painting worth $50 million for as little as $100? What if the deed to your house, your treasury bonds, even fine whiskey barrels could be traded instantly, 24 hours a day, 7 days a week, on a global digital marketplace, with no banks, no brokers, and no middlemen taking their cut? This isn't some distant science fiction. This is happening right now. The Boston Consulting Group estimates that by 2030, the tokenization of real-world assets could unlock a market worth $16 trillion. That's roughly 10% of the entire global GDP. BlackRock, the world's largest asset manager, controlling $10 trillion in assets, has already called it the next evolution of markets. But here's the thing most people don't realize. Most of the world has never had access to the best investments. The most profitable assets have always been locked behind high minimums, complex paperwork, geography, and gatekeepers. Real-world asset tokenization is about to blow those gates wide open. Stay with me because what we're about to cover will fundamentally change how you think about money, ownership, and investing. Welcome. In this video, we are going deep on one of the most significant financial innovations since the invention of the stock market itself, real-world asset tokenization, or RWA for short. By the time this video ends, you will understand exactly what RWA tokenization is and why it's exploding in 2025, how the technology actually works, without needing a computer science degree. Real companies and projects already doing this at massive scale, the serious risks and challenges that could slow it all down, and where this is all heading over the next decade. This video is for everyone, whether you've never touched crypto before or you're already deep in DeFi. We're going to build this from the ground up. And if you find this kind of content valuable, deep dives on the intersections of blockchain, finance, and the future, hit that subscribe button. We put out one of these every week and it genuinely makes a difference. Let's get into it. The problem with traditional assets. To understand why RWA tokenization matters so much, you first have to understand how broken the current system actually is. Think about real estate, the most popular investment in human history. Globally, real estate is worth an estimated $326 trillion. It's the single largest asset class on Earth. And yet, who can actually invest in it? If you want to buy a rental property in London, you need hundreds of thousands of dollars up front, plus legal fees, agents, surveyors, mortgage approvals, and months of waiting. If you want to sell it, same story in reverse. Private credit? The buyout fund your university endowment is invested in? Minimum investment, $1 million. Art funds? $500,000. Infrastructure bonds? Usually institutional only. The world's best investments have, for most of human history, been a members-only club, and the membership fee was being born wealthy or already being wealthy enough to access wealth. Now, this isn't new. Finance has always tried to solve this problem. Let's quickly walk through the evolution. The history of democratizing investment. In the 1600s, the Dutch East India Company issued what historians consider the first publicly traded shares. For the first time, ordinary merchants could own a piece of a massive trading operation. That was revolutionary. In the 20th century, mutual funds democratized stock market investing. Then ETFs, exchange-traded funds, made it even cheaper and easier. Index funds let ordinary people track entire markets for almost zero cost. Each innovation made investing more accessible, more liquid, and more efficient. But even with all of that progress, enormous categories of assets remained locked away. Private equity, commercial real estate, infrastructure, fine art, commodities, intellectual property, carbon credits. These assets share a problem: they're illiquid. You can't just sell a quarter of a skyscraper when you need cash. You can't split a Van Gogh painting between 10,000 investors, at least, not easily. This is the problem that tokenization is solving. Enter the blockchain. When Bitcoin launched in 2009, and when Ethereum introduced smart contracts in 2015, a new infrastructure was born: one that could represent ownership of anything as a programmable digital token on a transparent, tamper-proof ledger. The earliest experiments in tokenizing real-world assets began around 2017 to 2018. Mostly small pilots, a tokenized real estate deal here, an art fraction there. The infrastructure wasn't ready. The regulation wasn't clear. Institutional interest was basically zero. Then something shifted. Between 2022 and 2024, as crypto markets crashed and speculative NFTs collapsed, something interesting happened in the background. Serious money started flowing into tokenized real assets. Treasury bills, money market funds, private credit, real estate. By early 2025, the total value of tokenized real-world assets on public blockchains had surpassed $20 billion, and that number was growing at over 50% per year. Most people don't realize this, but while the headlines were focused on meme coins and NFT drama, some of the most significant financial infrastructure of the next century was being quietly built. And now, in 2025, the race is on. Breaking down the technology, simply. Okay, let's get into the mechanics. How does this actually work? The concept is simpler than you might think. At its core, real-world asset tokenization means taking something that exists in the physical or traditional financial world, a building, a bond, a commodity, and creating a digital representation of ownership rights on a blockchain. That digital representation is called a token. Think of it like this. Imagine you own a rental apartment worth $500,000. Right now, that ownership is recorded as your name on a deed filed with a government land registry. It's a physical document, or increasingly a database entry, that says, this person owns this property. Tokenization means taking that ownership record and putting it on a blockchain, a shared, distributed, and tamper-proof digital ledger that thousands of computers around the world verify simultaneously. And here's the powerful part. You can divide it. Instead of one token representing 100% of the apartment, you could issue 500,000 tokens, each one representing $1 of ownership. Now you can sell those tokens to thousands of investors anywhere in the world for as little as $1 each. The 4 core components. Let me walk you through the 4 key building blocks. 1. The underlying asset. This is whatever real-world thing is being tokenized. Could be real estate, treasury bonds, private equity, gold, carbon credits, invoices, royalties, almost anything of value. 2. The legal wrapper. Here's something critical that gets glossed over in a lot of crypto content. Tokenization doesn't replace legal ownership, it represents it. You need a legal structure that actually connects the token to the real-world asset. This is usually done through a special purpose vehicle, or SPV, basically a legal company created specifically to hold the asset. Token holders own shares of the SPV, which owns the asset. 3. The smart contract. This is where blockchain technology earns its keep. A smart contract is a self-executing program that lives on the blockchain. It automatically handles who owns how many tokens, distributing income like rental payments or bond interest directly to token holders' wallets, enforcing rules about who can buy or sell tokens, and executing trades instantly without needing a clearinghouse. 4. The blockchain infrastructure. The token itself lives on a blockchain. Ethereum is the most common for institutional RWA projects, but Stellar, Polygon, Avalanche, Solana, and even purpose-built chains like Provenance blockchain are all being used. The blockchain provides immutability, records can't be altered, transparency, anyone can verify ownership, composability, tokens can interact with other DeFi protocols, and global accessibility, anyone with a wallet can potentially participate. But here's where it gets interesting. One of the most underappreciated features of tokenization is what it does to liquidity. Traditional real estate takes months to sell. Private equity funds lock up your money for 7 to 10 years. Even some bond markets are surprisingly illiquid. You can't always find a buyer when you want one. Tokenized assets can be traded on secondary markets 24/7, just like cryptocurrency. Suddenly, the liquidity premium that makes illiquid assets less attractive starts to shrink. And when you reduce illiquidity, asset values can actually increase. Some economists estimate tokenization could unlock a liquidity premium of 20 to 30% on previously illiquid assets. Compliance and KYC, not just the Wild West. One more crucial piece. Institutional-grade RWA tokenization is not anonymous crypto trading. These platforms require KYC, know your customer, and AML, anti-money laundering, compliance, just like a traditional brokerage. Token transfers can be programmed to only work between verified wallets. Regulatory requirements get baked into the token's smart contract code. This is what makes RWA tokenization different from early crypto. It's designed to operate within, and ultimately upgrade, the existing financial system. This is not theory, it's already happening. Let's look at real examples. Because the most compelling argument for RWA tokenization isn't a white paper. It's what's already been built. Case Study 1. BlackRock's BlackRock Fund. In March 2024, BlackRock, the world's largest asset manager, launched the BlackRock USD Institutional Digital Liquidity Fund, ticker BUIDL, on the Ethereum blockchain. In simple terms, they tokenized a money market fund holding US Treasury bills. Investors buy BUIDL tokens. Those tokens earn daily interest from Treasury yields, paid out automatically via smart contract. Within weeks of launch, BUIDL surpassed $500 million in assets under management. By early 2025, it had crossed $1 billion. The significance here is enormous. This isn't a crypto-native startup experimenting. This is the world's biggest financial institution running live, at scale, on a public blockchain. Larry Fink, BlackRock CEO, has called tokenization the next generation for markets. That's not marketing speak from a believer. That's a calculated strategic bet from the most powerful firm in global finance. Case Study 2. Franklin Templeton's Benji. Franklin Templeton, a $1.5 trillion asset manager, went even further. Their Franklin on-chain US government money fund, traded under the ticker FOBXX, was one of the first US-registered mutual funds to use a public blockchain to process transactions and record share ownership. It runs on both Stellar and Polygon blockchains. Shares are represented as Benji tokens. Ordinary retail investors can invest through their Benji app. The fund yields competitive treasury returns, with the operational efficiency of blockchain settlement. This is the future of fund infrastructure: programmable, instant, borderless. Case Study 3. Centrifuge and real-world credit. Not all tokenization is about government bonds. Centrifuge is a protocol that lets businesses tokenize real-world assets like invoices, trade receivables, and loans, and use them as collateral to borrow stablecoins from DeFi liquidity pools. A small business in Brazil issues an invoice to a large retailer. They tokenize it on Centrifuge, use it as collateral, and borrow against it instantly, getting working capital without waiting 60 to 90 days for the invoice to be paid. The lenders earn yield from real economic activity. This is DeFi connecting to the real economy in a tangible, useful way. Centrifuge has processed over $500 million in real-world financing as of 2025. Case Study 4. Tokenized real estate, RealT. RealT is a platform that tokenizes individual residential properties in the United States. They purchase properties, create an LLC to hold each one, and issue tokens representing fractional LLC shares. An investor in Germany can buy $50 worth of tokens representing ownership in a rental property in Detroit. They receive their proportional share of rental income weekly, paid automatically in stablecoins. They can sell their tokens on a secondary market. Rental property investing, historically gated by geographic location, large capital requirements, and landlord responsibilities, becomes as simple as buying a stock. Case Study 5. Tokenized commodities and art. Paxos and Tether have created gold-backed tokens, PX Gold and Tether Gold, where each token represents 1 troy ounce of physical gold held in a vault. Unlike gold ETFs, you can actually redeem the token for physical metal. In the art world, platforms like Masterworks allow fractional ownership of blue-chip paintings, and blockchain integration is increasingly part of the infrastructure for provenance tracking and ownership transfer. Even luxury assets like rare whiskey barrels and vintage wine are being tokenized, turning collectibles into investable, tradable asset classes. Stay with me because this next part changes everything. Don't let the excitement blind you. Every transformative technology has real risks. And RWA tokenization, for all its promise, is no exception. Let's be honest about the challenges. Risk 1. The Oracle problem. Blockchains are perfect at tracking digital tokens. But how does the blockchain know that the physical gold in the vault actually exists? How does it verify the property is in good condition? How does it know a borrower defaulted? This is called the Oracle problem. You need trusted data feeds, oracles, to connect on-chain tokens to off-chain reality. Chainlink is the leading Oracle provider. But oracles can be hacked, manipulated, or simply wrong. If the real-world data feeding the smart contract is corrupted, the entire system breaks down. Risk 2. Legal and jurisdictional complexity. A token on Ethereum is global. The law is not. A real estate deal in Spain requires compliance with Spanish law. A bond in Japan requires Japanese regulatory approval. Securities laws in the US, enforced by the SEC, are notoriously complex and aggressive. Regulatory clarity on tokenized securities is still evolving in most jurisdictions. The EU's MiCA framework provides some guidance. The US is still working through it. Legal uncertainty is one of the biggest brakes on institutional adoption. Risk 3. Smart contract vulnerabilities. Smart contracts are code. Code has bugs. And when a vulnerability in a smart contract is exploited, there's often no undo button on a decentralized blockchain. We've seen billions of dollars lost in DeFi hacks. As tokenized real-world assets become more valuable, they become bigger targets. Risk 4. Custodianship and counterparty risk. Ultimately, someone physically holds the asset. If the custodian of that gold vault goes bankrupt, or the property manager disappears, or the SPV is dissolved fraudulently, token holders may find their tokens are backed by nothing. This is counterparty risk, and it doesn't disappear just because you put something on a blockchain. The chain of legal accountability from token to underlying asset must be ironclad. Right now, that chain varies enormously in quality across different platforms. Risk 5. Liquidity illusion. Tokenization enables secondary market trading. It doesn't guarantee it. If you tokenize an obscure piece of commercial real estate and issue 10,000 tokens, and nobody wants to buy them from you, you're still stuck holding an illiquid asset in a new wrapper. Liquidity requires deep markets. Deep markets require trust, regulation, and scale. We're still in the early innings. Where is this all going? Let's zoom out. The trajectory here is unmistakable. The convergence of forces, institutional adoption, clearer regulation, maturing infrastructure, AI-powered compliance automation, and the sheer economic logic of unlocking $16 trillion in value points in one direction. Here's what the next decade likely holds. Near-term, 2025 to 2027 tokenized money market funds, treasury bonds, and private credit scale from tens of billions to hundreds of billions. Major banks and brokerages integrate blockchain settlement. Several jurisdictions, likely Singapore, the EU, and the UAE, establish comprehensive regulatory frameworks, acting as on-ramps for global capital. Medium-term, 2027 to 2030 real estate tokenization goes mainstream in select markets. Carbon credit markets move heavily on-chain, enabling transparent tracking and trading. Stock exchanges experiment with tokenized equity settlement, reducing the current T+1 one-day settlement window to near-instant. The first globally accessible, blockchain-native index fund tracking diversified real assets launches. Long-term, 2030 most financial assets have a tokenized version. The line between crypto and traditional finance blurs into irrelevance. There's just finance running on programmable, interoperable global infrastructure. A teenager in Nairobi has the same access to a diversified global portfolio as a pension fund manager in New York. That last part, the democratization piece, is why this matters beyond just finance. It's about who gets to participate in wealth creation. For most of human history, the answer was Not most people. Tokenization might change that. The bottom line: real-world asset tokenization is not a trend. It's infrastructure. It's the process of bringing the world's $900 trillion in assets into a global, programmable, always-on financial system. The $16 trillion projection isn't a moonshot. It's a conservative estimate of a market that will be built whether the wider public notices or not. Here are your 3 key takeaways. 1. Tokenization converts ownership of real-world assets into digital tokens on a blockchain, making them programmable, divisible, and globally tradable. 2. The technology is proven and scaling fast, from BlackRock's billion-dollar treasury fund to fractional rental properties in Detroit. This is not theory. 3. Significant risks remain: legal, technical, and market risks, and the infrastructure still needs to mature. But the direction of travel is clear. My opinion? In 10 years, we won't say tokenized assets any more than we say electronic trading today. It will just be how assets work. The question isn't whether this revolution happens. The question is whether you understand it before it's already happened. If this video gave you a genuinely new way to think about finance and blockchain, drop a like. It takes 1 second and it helps this channel more than you know. Now here's my question for you, and I genuinely want to hear your answer in the comments. If you could tokenize and invest in any real-world asset for as little as $10, what would it be? Real estate? Gold? The Picasso? Or something completely unexpected? Drop it below. Best answer gets pinned. And if you want to go deeper on the DeFi ecosystem that's making all of this possible, watch this video next. It covers. Subscribe so you don't miss the next deep dive. We'll see you there. Warning disclaimer: this video is for educational and informational purposes only and does not constitute financial advice. Investing in any asset, tokenized or otherwise, involves risk, including the possible loss of principal. Always do your own research and consult a qualified financial professional before making investment decisions.